Hello everyone. Business Economics. This is Dr. P. Kumarasamy, Assistant Professor, Department of Commerce, UG, Kristu Jayanti College, Autonomous, Bangalore, Karnataka. Topics that we are going to cover in economics: fundamentals of economics, meaning, principles, nature, scope, importance. Economics is art or science. Fundamentals of economics. Business economics is playing an important role in our daily economic life and business practices because of emerging of a type of a business in the past and present, economic reforms in Indian economy, need of survival of the business, need of a business decision regarding pricing, demand and supply, cost and revenues, etc. Hence, business economics becomes an the important discipline. In 1951, Joel Dean published a book entitled Business Economics. The subject business economics has gained popularity. Business economics reveals that how economic analysis is used to formulate the economic policies in respect to the business firms. Principles of economics. There are six basic principles of managerial economics. They are incremental concepts, the concept of the time perspective, the opportunity cost concept, the discounting concept, the equimarginal concept, risk and uncertainty. The incremental concept. The incremental concept is closely related to the changes in the total marginal cost and total marginal revenue of the business firms. A decision is clearly a profitable one if it increases revenue more than cost, it reduces cost more than revenues, it increases some revenues more than it decreases others, it decreases some cost to a greater extent than it increases others. The concept of a time perspective. In the business economic theory, decision makers should give due consideration to the both the short run and long run. One should not be affected by another decision taken. A decision may be taken regarding variable and fixed cost or revenue like fixed selling price, a percentage of a profit, etc. Number three, the opportunity cost concept. Opportunity cost represents the benefit or revenue foregone, that means sacrificed or abandoned, by pursuing one course of action rather than another. Example, the loss of other alternative when one alternative is chosen. The ideal cash balance represents an opportunity cost in terms of lost interest. Equimarginal concept. The principle states that an input should be allocated so that value added by the last unit is the same in all cases. This generalization is popularly called as equimarginal. Let us assume a case in which the firm has 100 units of labor at its disposal and the firm is involved in 5 activities wise A, B, C, D, and E. The firm can increase any one of these activities by employing more laborers but only at the cost. It means sacrifice of other activities. Example, utility of a first product should be the same to the last product that we consumed at the same price. The quality and level of utility should be same when price is same. Discounting concept. Since the future is unknown, incalculable, there is a lot of risk and uncertainty in future. Everyone knows that 1 rupee today is worth more than a rupee will be 2 years from now, as it has more alternative course of action to earn more than that. The concept of discounting is found most useful in business economics and decision making is used in investment planning or capital budgeting. Risk and uncertainty. The uncertainty is due to unpredictable changes in the business cycle, structure of the economy, and government policies. The management must assume the risk of making decisions for their institution in uncertain and unknown economic conditions in future. The firm may be uncertain about production, market prices, strategies of rivals, etc. And uncertainty, the consequence of an actions are not known immediately for certain. Business economics, according to Mansfield, Business economics is concerned with the application of economic concept and economic to the problems for formulating rational decision makings. The Spencer and Segelman business economics is the integration of economic theory with business practice for the purpose of facilitating decision making and forward planning by management. Nature of business economics. Business economics is a science. Economics integrates the tools for decision science such as mathematics, statistics, and econometrics with economic theory to arrive at appropriate strategies for achieving the goal of the business enterprises. It is based largely on microeconomics, the long term survival and profitable functioning of the organization. Incorporates element of macro analysis. Economic manager must consider about the general price level, income and employment level in the economy, government policies with respect to taxation, interest rate, exchange rate, industry prices, distribution and wages, and regulation of monopolies. Business economics is an art. It involves a practical application of our rules and principles for the attainment of set objectives. The use of theory of markets and private enterprises. It uses the theory of the firm and the resource allocation in the backdrop of private enterprises economy. Pragmatic in approach. Microeconomics is abstract and purely theoretical and analysis of the economic phenomena under unrealistic assumptions. In contrast, business economics is pragmatic in its approach as it tackles the practical problems which firms face in the real world. Interdisciplinary in nature. Interdisciplinary in nature. Business economics is interdisciplinary in nature as it incorporates tools from other disciplines such as mathematics, operation research, management theory, accounting, marketing, finance, statistics, and econometrics. Normative in nature, economic theory has developed along two lines, positive and normative. A positive or pure science analysis causes and effect relationship between variables in an objective and scientific manner, but it does not involve any value judgment. As against this, normative science involves value judgment. It is a perspective in nature and suggests what should be a particular course of actions under a given circumstance. Welfare considerations are embedded in normative science. Scope of economics. Economics covers two different categories, microeconomics and macroeconomics. Both of these sectors cover different parts of the business economics. As microeconomics applies to internal or operational issues that arise within the organization and fall under the purview of management. Macroeconomics focus on external or environmental issues that influence the functioning and performance of the business. Scope of a business economics are demand analysis and forecasting, cost and production analysis, pricing decisions, policies and practice, profit management, and capital management. What are the importance of a business economics? Better decisions of a business in a real life. Other importance, other disciplines such as psychology, sociology, and used in various situations of the business. Competent model builder to the economist. It integrating agent in operations, finance, marketing, and personnel. Cognizance interaction between society and goals. The limitations of a business economics. It is unpredictable, non-replicable, no unified solution, open to political manipulation, inaccurate conclusion. These are the limitations of business economics. Thank you.